What's up, Bitcoiners? It's Edward, Deadly Crypto. In this video, we're going to be talking about multiple time frame analysis. So traders generally make use of 3 time frames when plotting a trade. It can be any 3 time frames, but the time frame relativity does matter. So if you're using the daily time frame as your bigger picture, you don't want to be using the weekly or monthly time frame to try to find an entry. Your data is going to get a little bit disrupted because you're looking at a larger plot of information. So a top-down approach is recommended. The trading time frame should lie in the middle. You should use the larger time frame as a general path and the smaller time frame for entry and exit targets. So you want to relay the information presented by both the candlesticks and the indicators to find trading ranges. You'll also want to determine how long you'll be in a trade while you're doing your multiple time frame analysis. So let's say right here, for example, the very first thing we need to take note of on the daily time frame, with this area that we happen to be in, which is a support zone in the middle of a downtrend and an uptrend. So it could possibly go 6% before we have an idea of what's actually happening down, or it could actually go, 6% up before we have an idea of what's really happening. We need an outbreak to occur. So that is going to give us 19-day, 37 days, right? So here we're going to be looking at 19 days. There could be an outbreak. It goes up, and then here's a retest. Or it goes down and here's a retest. So we're going to have some more information about 36 days about how confident we can be in a short or long position, because one of these is going to be respected or disrespected. So that gives us a time projection. So now that we have a time projection, we're going to take note of how far we are from the 9 EMA. So we're going to use that as red. And I'm going to draw one more line right up here where the 26 EMA is in green. I don't want to get it confused with the take profit goal, so I'm going to mark it as green. That way I know it's the 26 EMA. So these are 2 possible ranges where the candlestick on the daily time frame can go to test again. I'll go ahead and drop that one down a little bit lower and drop this a little bit lower. As we can see here, once the candlesticks were on a sharp downtrend in this scenario, they used this as resistance, flipped up for support, and then poked even above that. So we have these 2 ranges to go into on the daily time frame. And of course, here we have already tracked this on the daily time frame, so we'll use that as our lower range because price is already far from the 9 EMA. We don't have anything else to mark on this way down. So now we're going to break into the 4-hour time frame using a top-down approach. The next time frame we're going to want to observe is the 4 hours. So we have all our indicators here. We're looking at a valid downtrend. So in our previous video, we have talked about the death cross. Here we can see a death cross where the 50 crosses the 200. The 50 in this chart is indicated by the blue line, and the 200 is the orange. So here is the death cross, and then a retest and another retest of the 200. So that is a valid downtrend. And just as you know it, boom, we have a few retests that everyone can see. The traders who are looking at the 4-hour time frame, then there's a huge spill off. Boom, off of that retest right there. It's like, all right, that's it. That's a lower high, so now everyone's starting to take their shorts. This area of support just gets plunged through as people's trades start gaining profits and other traders start to open shorts. Then we have a touch of this retest outbreak. So here we can see now there was a lot of buying support even as we dipped into that support zone previously indicated. So there was a lot of buying activity there where buyers showed support. Now we're getting into that region again. It was only a matter of time. The bears are trying to push through again as we see resistance along the 200 EMA, which is also a new downtrend line that we are projecting. So because price broke over this, which was a previously valid downtrend line, now price has come up to here, but it's starting to create a lower high. So we can range a new downtrend line off of this, as previously we had projected this downtrend line off of these values. And it was respected for a lot of time. So there was a lot of buildup in candlesticks here, but nothing was able to sustain above that. Ultimately, we saw that fall off right there along the EMAs. So we could see how this helps us provide trading opportunities and trading ranges, even on the 4-hour time frame. We're starting to notice. So now on the 4-hour time frame, if this is where we want to plan our trade, we're going to see if we're going long or short. And here we identified these values on the daily time frame. So looking at it now on the 4-hour time frame, this actually isn't too improbable for a support bounce, and we can measure that out for a long trade to see if it's worth the entry going in now at market price, or maybe waiting for the possibility of a better entry. Or if we want to continue to short this, since it's a valid downtrend, we got rejection here, Since this is a valid downtrend, we're going to want to try and find an entry for a short here to target back down to some of these ranges. Those are some of the possibilities we have based on the 4-hour time frame. So generally speaking, whenever we use multiple time frame analysis, we need to plot if we're going to be taking a short or a long and our risk to reward ratio. So we have another video covering risk management in detail, but for the purpose of multiple time frame analysis, we need to try and establish a risk to reward ratio, at least so we can see what our projected targets will be. So we're going to try and take a look at both a long and a short. First, we're going to try the long here. So we're going to gauge if we can get an entry back at the bottom of the support line. Really, after observing this, we would have liked to have tried to target that as an entry, but it's possible here that price could swing back in this direction, as that was a swing low. So we'll try to get an entry a little bit lower than the current price, as if it gets rejected from here, we'll find a better entry. So this is what's generated for us. It gives us a 1-to-1. Let's adjust some of these targets. First, we'll need to adjust our stop loss to a reasonable support level. So if we take a look at this downtrend, continue some of these projections, we could see the possibility of support along several regions here. So naturally, if price comes into this region and wants to bounce below this range, it's probably going to continue a downtrend, and then if we extend this over here, price would naturally do something like this. So if we enter a market price right now or close to the bottom of the support zone and price disrespects this right here, it's probably going to do something like this. Maybe find rejection here, come down, explore this range. It could bounce back up here even, but that would still put us below our entry to where we would just get stopped out of this position if we don't get stopped out the first time. So those are a couple opportunities if it jumps down. Although if it goes up from here, we could see resistance in this point, maybe support along here. Finally, some more resistance in this area as we converge against that downtrend, and then possibly back up to here, as that was the 26 EMA on the daily time frame, if you recall. So now to adjust the long target, we would at least have to go and match the stop loss, as the trade has to be 1-to-1 for it to make sense. If we're only targeting this much of a gain, a 2% gain for a 6% loss, that's not a reasonable position to be taking. We should either move the take profit higher or move the stop loss lower. So we could target here and say, okay, now if I want to try and target, I'm jumping in at market price, and we're in the middle of the support range. Price could go lower and it could go higher. So I want to try and trade the support range now. Okay, that makes this trade a little bit more reasonable. It's a 1-to-1. If price goes down here, then it's likely to continue. As we just stated, it could continue down. But instead of writing down all that loss, you get out and you say, okay, now I'm stopped out at this position. So just imagine you took this trade, you got stopped out here, instead of writing that loss that we had just looked at. So the loss we just looked at was 6%. So now you imagine we're right here, and instead of taking that 6% loss, you waited to find a better entry, and you actually do get in somewhere around here as support is found later. So now price comes this way, and your trade becomes a lot better. Now you enter a new stop loss region. So now instead of writing this all the way down to a stop loss where you get stopped out for a 1-to-1, you got stopped out at 2%, waited for a better entry, and now you've lowered your potential for stop loss to a new range, and you're flipping your potential for a better trade. Because now targeting an entry to this support line will give you a more profitable attempt at this outbreak rather than buying while floating in the middle of the support zone. So same thing, if you wanted to try and plot a short on this, it looks like this is a valid downtrend, although we are getting into a region where the MACD usually flips on this time frame. You could plan a short trade as well if that's what you wanted to do, and you would say, okay, maybe I want to short this resistance zone, or I can short from the 90 EMA if it doesn't find support. So if it gets rejected right here, then I can get stopped out along this, as this was the 90 EMA on the daily time frame, which price is likely to go to, and then chase my target down to here. So now that looks like a little bit of a better trade than the long we had just set up. So here's the long we just set up versus the short we just set up. I've zoomed into it now to make it a little bit more visible on the 4-hour time frame. So this is the potential ranges we're looking at. If we want to short, that would be an optimal short, trying to short sell that retest on futures even, and try to target this as a 7% goal, which makes this way better than 1-to-1. It's almost 1-to-2. It's over 1.15, which is a great risk to reward ratio. Although the 4% loss is kind of scary. Nobody wants to lose 4% on their position. If we can minimize our stop loss as much as possible, that's ideal. However, this is the trade that you would be looking at as it's very possible that price could go to the 9 EMA on the daily time frame, and that's what this line represents if you recall from the analysis we just performed. And here's the long, so this is a little bit better than 1-to-1 if you wanted to play this, but it's a bit of an unnecessary loss. There's no reason to try and risk this much loss when it's possible that you have a little bit more downside potential. Although if we get this bullish cross, it might prompt you for a better entry if you get the retest up here. If price comes up here, then you can, instead of trying to short at this point, whenever price moves above this, you can move this trade up. So now you're taking your entry on the retest. So if price comes up here, you can buy the retest, and you slide your stop loss up to the bottom of this resistance zone here. Now you're looking at a much better long. So now this becomes almost 1-to-2 as well. You're looking at just about the same ratio, and either way you can calculate these exactly to see which one is better, as that is a previous uptrending line. And even on the daily time frame, this was the 26 EMA that we had marked. So there's plenty of upside potential if you wanted to try and take this long. Even it can turn into a 10% gain if you chase it up with a dynamic strategy, or even if you just try to target that by itself and move your stop loss up as price goes up. So now that you've done this on the 4-hour time frame, you want to try and find the best entry. You have your targets, and you want to try and find the absolute best entry. We can go into the 1 hour or the 15 minutes to see what's happening on these smaller time frames. Just know that you can get into even the 1 minute time frame. However, if you're using the 1 minute time frame, you might need to use the 5 or 15 minute as your bigger picture. But for the purpose of this video, we're going to be using the 1 hour to try and go in and snipe our entry. So now we can see our risk to reward ratio set up a little bit better. Possibly the candlesticks will be rising above the 9 EMA soon, and we have on our indicators a little bit more information that needs to be considered. Here it looks like the downtrend is losing strength, and it's possible now, if this starts to come to reset, that we could see a reversal into an uptrend. The uptrend is a bit exhausted here, but still hasn't flipped over the histogram, and the RSI looks to be battling some kind of hidden divergence. There's also divergence here, as we can see. Price is sloping downward, while the RSI is sloping upward. So this is an example of divergence. We cover this in great detail in our other video, RSI 101, so take a look at that if you haven't seen it yet. But just to quickly show how multiple time frame analysis can prompt us to make a better entry, if we extend this out here, we can see if the RSI breaks below here, it may continue a downward trajectory, so we'll have to be wary of that. And the time frame for our divergence here now is about 1 day, 15 hours. So it's possible that we could be looking up to right here for our closure of a trade, based off divergence being 1 day and 15 hours. From this point, that would be about right here. So now if we're looking for a long, we can go in for market price, try to set up a market price right here. And we'll set our stop loss to just below the most recent swing low. So if price comes down below that candlestick right there, we'll say we'll get out of the trade and try to plot a better entry before taking any more loss. And now moving back up to that price point, this becomes a 1-to-5 trade. So if you want to target that same goal, or if you want to come down and target some of these other EMAs, now it's a little bit better to try and even make a day trade, or even wind it down into a scalp scenario on a smaller time frame. So if this bullish move continues upwards, we technically don't have a bearish cross, so there's not much telling us on the 1 hour time frame to short this. Although by the time price does get to this point, we will have technical differences. As we just plotted here, this is about when the divergence would play out based off of this measurement here. So here's the start of the divergence again, 1 day, 17 hours. So from this point, we'll measure over 1 day, 17 hours, which is right here, January 9th actually. I'll scoot that over. So there we have it. Now we should be looking to take profits on this position because our divergence signal will be expired, or we can try to take partial profits and chase up to some of these other targets, like right here, the 100 exponential moving average. It's very possible that we could use that as resistance. So this would be a counter trend trade if you wanted to take a long, as the larger trend is a downtrend, but you're wagering a entry into a long position to try and target some of those on the way up. If price gets rejected here, ultimately you still would have made 5% and you can close out for a profit. So you set up both of these trades here now. Let's just say, for example, you do take this divergence signal. It does go according to plan. You get this outbreak, and then there's the retest here, but there's not another higher high, and price continues to go lower. Well, you took profits over here on this long, and you still have this short set up. So you could actually take your entry here, or wait for this retest right here, And then you could take your short entry and try to target this on the way down some more if you continue to see a series of lower highs and lower lows. After you get to this point, this trade is expired, but you've already taken profits on it, potentially. If you get stopped out, you got stopped out. But you still have this other opportunity here that you've charted, and now you've actually nailed that entry in too. So you could scoot this over and wait for maybe that retest. Like I said, after there is a retest, you're going to want to be shorting this, and that is a valid trade as well. That's the one that we charted out. It's a little bit over 1.5 RR, so which is a risk to reward ratio. So just zooming in a little bit closer, we're going to take a look at some of those other principles we used earlier about charting market structure. Here we could see a downtrend by using different swing highs. So this is a swing high and this is a swing high. These are two valid downtrend projections. I'll go ahead and turn these red so that way we know they're downtrend projections. So if we have this breakover right here on this downtrend, that could be also an area that we're like, okay, if price gets rejected and starts to go back down, I can take profits, get out of this trade, because there's nothing wrong with closing a trade early. Even if it doesn't reach your full take profit goal or stop loss goal. There's nothing wrong with closing a trade early. If price gets rejected right here and shoots down and you're like, well, now it's going to get rejected off this, you don't have to wait and take that full minus 1.14% loss. You can cut out at minus 0.8 if that's what you think. You don't have to sustain the whole loss. And if after price breaks this downtrend line right here, you don't think it's going to break this one, you're like, okay, I want to take profits. I'm just going to go ahead and take profits because this is playing as rejection now. I'm just going to go ahead and get out of the trade. You didn't have to wait for all this time to pass to close it, or you didn't have to wait for that take profit goal to be achieved to close it. You wanted to manage this because now you're also using that market structure on smaller time frames too. The same trend line analysis that you used earlier and support and resistance zone that you used earlier. We don't have much of a horizontal resistance point here. Most of this is dynamic. So that's what you're going to have to use to identify your trading ranges. Multiple time frame analysis allows you to have these trading ranges. So if you extend them out, both of these could possibly be support and resistance flips. So now if price comes over here and you do take this short entry, you have a target here. But if price finds support here and then ultimately along the bottom of the support band starts to come back up, you know it's time to take profits on your short. So you don't have to wait for price to come to either all this dramatic stop loss or all this awesome profit. You don't have to wait for price to fill out in either direction. If you see that price is coming back upwards and you're in profits, you can take profits because you've mapped out your TA, you're watching your trade, and you're observing it in these price ranges that you have identified, from both all the way from the larger time frame down to the smaller time frame. So these are the basic principles of technical analysis. There's market structure, there's using indicators, and then there is multiple time frame analysis. There are a few more things involved in trading whenever the trade does become live and your money actually gets put into the position, like managing your risk and managing your emotions. So that's it for this video. I hope it was helpful. As always, thanks for watching.